All right, welcome back to Yahoo Finance Live, heading toward the closing bell in just under, looking at 23 minutes. Let's talk about where the markets are right now, because we just heard from Federal Reserve Bank President of New York, John Williams, and the markets, if we can pull them up, please. We've got the Dow is up about 16 points, the S&P 500 still negative, as is the NASDAQ. Let's bring in Joe Brusuelas, who is RSM Chief Economist. It's good to see you, Joe. And at the end of the interview with Brian Chung, they were talking about R-star, which is teach us. It's the natural interest rate. How does that work in the real world? And what does that mean for investors with the Fed considering what its next move will be?
All right, well, first, congratulations to Brian on a deep and informative interview, really illuminating. Okay, so the natural rate of interest is incredibly important because that underscores how the Fed sets its interest rate policy. What it tells us is if you look at it, it's just above zero. It's barely there. That means the Fed will be stuck along the zero boundary for a long period of time. What was interesting is John Williams chuckled a bit and says, well, if you look back 25 years, it's very different. I have it up here on my screen right now. The natural rate of interest 25 years ago was 3%. And that just tells you how far we've come, how much the economy's changed. And really, any idea of what, quote unquote, normalization in the path of monetary policy or the federal funds rate is years ahead of us.
So, Joe, with all that in mind, and when we heard from President Williams, he was very optimistic just about where we were in this economic recovery, although he did stop short of saying that we should think about changing monetary policy at least anytime soon. But what's your assessment, I guess, from where we are in this recovery and versus where you expected us to be at this point as we head into June?
Oh, well, the outlook of my year ahead was welcome to the boomtown. We're entering the boomtown now. Look, I think that we are about to pivot from recovery to expansion in the economy. I think that it's appropriate that members of the Federal Reserve begin to signal to markets that things are not going to be the same forever, that it's appropriate they begin to think about tapering the pace of asset purchases at the very least, or altering the composition of those asset purchases. I saw a central banker who's very sanguine in terms of the economic outlook. I don't think he's complacent. I think he's very confident in their prediction or their forecast in terms of the path of inflation. I'm in the transitory camp, so I'm in agreement. But, it does make sense that later this summer, perhaps as early as Jackson Hole, or at the September meeting, we'll get a much more definitive forward look from the central bank on the end of those asset purchases. I expect they'll start early next year and take all of 2022 before they're finished with it.
Joe, but he said in the interview, quote, right now we are not near the substantial progress marker, when he was asked about when to begin the discussion. So what does he say?
Well, I think what he's saying is that, we may be moving into the latter stages of recovery or indeed expansion, but it will be at least one more year before we're anywhere near full employment, depending on how you define that. I define that as somewhere between 3.5% and 4%. And at that point, it would be appropriate to begin exiting those asset purchases. This is just going to play out over time. And I think there's at least some portions of the market that may be a little bit out over their skis with respect to expecting it to occur sooner rather than later.
And Joe, when he was discussing the labor market, he was saying that this process will likely take several months, talking about the labor shortage that we're seeing in some areas, some businesses getting up to speed just in terms of what they want. When we turn our focus to tomorrow morning, 8:30 a.m. Eastern time, what are you looking for in tomorrow's report? Okay,
so tomorrow's going to be a very challenging report to interpret. The long echo of the pandemic will result in a damped seasonal adjustment, which would tend to push the estimate higher than it normally would be. All right, so we're in some interesting areas. I think we're going to see a very strong report. I think 600,000 makes sense to me. You saw the ADP report. Given that damp seasonal adjustment, that's definitely in play. I would not urge people to overinterpret that single report. Take a step back, create a smooth 3-month moving average. You should expect a very strong report in June, and then some muted reports probably in August and September. And it's just going to be a while before we get a real sense of where we're at. I think a good solid trend of 500 to 600,000, That's a very strong labor market. Central bank can afford to be patient as they see this. I don't think we're going to be running up against any significant inflationary pressures because we really need to see three things. Huge hiring months, that'll take a while. 2, demand pull inflation from wages. And 3, changes in inflation expectations. None of those three is really right in the cards right now. So the central bank has time to be patient, to observe where we're going in terms of expansion and how long they expect it to be before we're back to full employment.
Joe Brusuelas is RSM Chief Economist. It's always good to have you here, Joe.